Yo, what's up, everybody? It is Tuesday, March 18th. Here's a question. Could the Trump policies, or the threat of the Trump policies, let's put it that way, be right now a catalyst to a change that is happening to the U.S. economy? I ask this question because we saw today a significant increase in industrial production. And also, we saw capacity utilization, which has been hovering like around a 76 or 77% level. It jumped up to 78.2. Now, that might not seem like a high level, but that is the highest level in a year. Okay. And what's interesting, like I looked at the trend of capacity utilization, and it's been going down steadily since 2022. And then all of a sudden, in November of last year, which was when we had the election, that trend line, that downtrend line on industrial production was broken, and now industrial production is increasing. I mean, capacity utilization. Now, why is this maybe significant? It's maybe significant because Trump's tariffs, or the threat of tariffs, is starting to trigger a let's manufacture it here environment. Now, this is really, really important if this is actually happening. And I think there's a strong case to be made that this might be the beginning of a cycle right now where we're seeing more firms invest domestically, produce here because of the threat of tariffs. And this was the intent. This was Trump's intent on the tariffs, like make it here. Okay, I've done a million videos on how, me personally, I think we got the best arrangement right now where we get the imports, which those are the real assets, and we just basically give them dollars that are a keystroke on the magic computer, like Elon said. But anyway, let me leave that discussion aside. Is the point I'm trying to bring up here, which is something we gotta pay attention to, because if this is happening, this is going to impact the economic environment now for, I think, quite some time. If we see a shift in domestic investment, non-residential domestic investment. And I'm going to be looking at that now, in the GDP reports. That's going to be a very important focal point for determining if these policies now that Trump is implementing, if that's having the desired effect. If it is having the desired effect, then that could be huge. I mean, we're really talking about a sustained level of economic growth where we are adding to physical capacity or using a lot of dormant capacity. Like it's been like that. If you go back to the 1960s, the 1950s and 1960s, the United States, we were running at, 95, 96, 97% of capacity. That was before all this offshoring started. That was before China became this, manufacturing powerhouse and stuff like that. We were running in the high 90s of capacity utilization. And then it all started to go down, and we've been kind of stagnant at around a 76% capacity utilization level for decades, man, because everything's been offshored. Everything's been made in China or Vietnam or whatever. So this was Trump's intent, and it can have profound effects. Now, I don't know if this is something like long-term sustainable, because again, the private domestic business sector, they're not currency issuers. I mean, they're sitting on tons and tons of retained earnings that they can use or they could redeploy into productive investment, which would be great. But it's not something that can be sustained over like an indefinite amount of time. But we're still talking about years, because there's a lot that could be done in terms of capacity, new plant, new production facilities. Like we just had like last month or something like that. You had Apple what they said they were going to invest 500 billion. You had Taiwan Semiconductors said 100 billion. You had a bunch of companies, and Trump made these announcements. These guys were at the White House. You had a bunch of companies saying, yeah, we're going to, in a big way, up our domestic investment. So this is an important development if it's actually happening. You know, maybe it's just a one-time thing. But I mean, I looked at that trend, and it definitely looks to me like it broke that downtrend and we're on the way back up. And that would fit with, you know, like what's going on right now. So that's something very interesting, and again, it could have major impact for the economy, obviously for the stock market. The numbers that came out today were strong. All right, so I mean, again, I don't see, you know, I've been talking about fiscal flows. They're very strong. I don't see recession in the forecast. I mean, I understand the first quarter contraction that the Atlanta Fed. By the way, did I talk about this the other day, that Howard Lutnick? I call him now, my name for him is Donkey Face. I don't know why, but like, he looks like a donkey. He's got that beard. You know how donkeys have that kind of donkey face? And he was on with Maria Bartiromo, Fox Business, the other day, and when she said, well, the Atlanta Fed is forecasting a 2.4% contraction in the first quarter, he's like, what? What are you talking about? What? And he's like, you know, every time he talks, he's half giggling, donkey face. And she said, well, yeah, didn't you see it? No, I didn't see it. This guy's in charge of a major, you know, aspect of the economy as Commerce Secretary, all right? You didn't see it. You don't look at the numbers. She said, did you talk to the Atlantic Fed? No, absolutely not. Like, why the emphatic absolutely not? Like, I would never talk to the Atlantic. Like, come on, man. Like, I think he could have explained it if he understood it. I don't think he even understands it, because he was a proponent, a backer of Elon Musk's suggestion that we ought to strip out government spending from GDP. I mean, it's like, I did a video on it. I'm like, come on, man, this shit's getting comical already, you know? So like, you would explain it that it's gross domestic product, okay? It's what we produce here domestically. So the foreign sector, that is a subtraction because it's produced in the foreign sector. So the United States runs perennial trade deficits. So when they do the GDP calculation, which there's 4 components, okay? There's personal consumption expenditures, there's government spending, there's business investment and spending, and then there's, you know, net, they call it net exports, which is exports minus imports. So like, we import more than we export, so that number is always negative, so it's a contraction. But this time in the first quarter, the forecast is a big record contraction because all the firms, you know, they jumped ahead of the tariffs. They wanted to get inventory before the tariffs hit. Understandable. So it could have been explained like that. Like, he could have said, you know what? Yeah, I saw the Atlanta Fed's negative, but the reason why that happened was because firms decided to stock up on inventory before the tariffs hit. It's totally understandable. It does not indicate any contraction in demand. As a matter of fact, it indicates the opposite, that firms are, you know, they're optimistic, they're positive, they want to load up on inventory before the tariffs hit. And, you know, the flip side of the trade deficit is the capital account, all right? So the trade deficit might increase, the negative, the capital account goes up, that's the positive. That's a whole other discussion. Maybe one time I'll explain it. I don't want to get into it right now. Could have said that. But like, it's like, no, I would never talk to the Atlanta Fed. Donkey Face said that. So like, I don't see anything like in the numbers, right? I've been talking about, you know, gold's at an all-time record high. If we were in a recession, believe me, folks, Many of you probably don't believe me, but one day, if we get in a recession, you'll see gold is going to go down significantly. Gold's not going down. That's an indicator to me that we are not in a recession or at the doorstep of a recession. The other thing, you look at other industrial commodities like copper, very strong, things like that. Even crude, it's holding its lower levels. I've been saying for almost 2 years now, every time it gets down to 66, you're a buyer, okay? And by the way, the U.S. has resumed filling, the Trump administration has resumed the refilling of the Strategic Petroleum Reserve. I mean, they were out for about 3-4 weeks. We didn't know if they were gonna resume, and they announced they are resuming that. And I saw that in the data in last week's Energy Information Administration's release that comes out on Wednesday. We got another one that comes out tomorrow. So, like, I don't know, man. I think the economy is fine. Maybe there's been some slowdown in consumer spending, although we saw retail sales were good. Fiscal is very strong. The market got spooked by all the time. This is the headline trade, you know, and I've said to you guys so many times, like, you got to really discipline yourself to go against these headline traders, because what they do is purely out of emotion. It's from a total lack of understanding, many times related to, you know, monetary policy or fiscal policy, or, you know, the debt, all this kind of stuff, where they freak out. I mean, every month or every couple of months, you got this Ray Dalio, who should retire by now. He's on some show like CNBC or Fox Business saying, we're almost there where the debt is going to cross the line. He's been saying this for as long as I've been aware of this guy, and I've been in this business for over 40 years, okay? And I've watched him or listened to him over the years, over the decades. I can't even stomach this guy anymore. He looks like a total fool to me, but whatever. You know, always doing the Cassandra, the sky is falling. But all these people are. You know, we were talking about this. I was talking about this to you guys last year with the interest rates, and you had, what's his name, Drunken Miller and Paul Tudor Jones and Gundlach and all of them saying, you know, rates are going to skyrocket and inflation is automatically built in. And meanwhile, we're seeing all that stuff start to trend. They've been trending back down nicely. So today we were down. Yesterday there was a tax drain, which I told you guys about like months in advance. I said March 17th tax drain. It's not a big tax drain. It was down about 54 billion yesterday. Probably down a little bit today. I mean, I think the effect of that was twofold. I think number one, it helped to drain out some reserve balances. By the way, we saw an excellent 20-year auction today. Like every time that happens, I'm always thinking to myself, who's going to buy them now? Like all of these guys, like Dalio and Bill Gross and all these guys, who's going to buy the bonds? The money has to be there before any bond ever gets sold. Bonds, you know, how many times have I explained this, that bonds can only be bought with US dollars. And the government has to spend the dollars into the economy first before anyone has the dollars to buy the bonds. And the sale of bonds or notes or bills, all that is a reserve drain. I did a whole bunch of videos on this about why we had so much volatility and pressure in the stock market recently, because the debt ceiling has inhibited the ability of Treasury to drain reserves. And you've had, remember, I did the bilge pump. I did a whole bunch of things that are talking about the bilge pump analogy. Many of you probably remember it. If not, you go back and check out my videos. I'm not going to go through it again today. But so we had a reserve drain on Monday, okay? with the tax drain. All right. We had a strong day yesterday, but the system, at the same time, the system's left with a little bit less free cash because of that tax drain. So it's normal that we had also a pullback today. The market tried to recover, but I don't see this as anything, switching back to that very violent sell-off. And tomorrow we get a Social Security payment. Look, this particular tax drain, this March 17th tax drain, it should last about a week, the effect. Okay, that was the same thing that happened. I checked out last year. It was 6 business days, and basically all that drain was recovered. We still got the issue of the debt ceiling. All right. But there's been a nice increase in bank residual, which is basically capital. It's assets minus liabilities. So that gives the system a little bit more, leeway, a little bit more play. So I think the bottom is in for now. The only thing that I'm looking out for now is the April 15th and May 1st. We got those dual, and it's really the May 1st because that was the IRS tax extension to storm areas from last year. That applied to me. And that, that's been like a temporary tax cut. That's going to be taken away. So that April-May period could see some more downside in the market at that time. But from the April 15th to, sometime maybe through the end of May into June, we'll have to see how that plays out. But I just want you to be aware of that up front. All right. And I think that could be also a window. Like if you're looking to short gold as a trade, I wouldn't right now be short as kind of a strategic, but if you want to do a trade, if you're looking to trade it, if you're thinking like it's overdone, I would look at that mid-April through May period as a topping period. Anyway, that's it for today, folks. Please like and subscribe if you've already done that. Thank you very much. And don't forget to go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. And that's it for today. Have a good one. Bye.